Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Sysco stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 37 billion market cap. They're trading at $76 a share, and they have 492 million shares outstanding. Sysco markets and distributes food and related products to various companies in the food service industry. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Their free cash flow went down from 21 to 22. It was 1.2 billion, then up 79% into 2023, 2.1 billion. It is down a little bit in the trailing 12 months, a little under 2 billion. As you probably imagine, they have really thin margins. They only convert 3% of their revenue to free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that goes up each year. It went up 300% from 2021 to the trailing 12 months. Revenue is a sales for the company, and that goes up a lot from 51 billion to 78 billion. But companies that operate in the food industry sell a lot of product, but with low markup. You can see their net profit margins between 1 and 3%. Supermarkets have even thinner net profit margin. Costco and Whole Foods aren't as bad. Their margins are a little higher, but not nearly as high as a tech company, for instance. And you do get a nice dividend with this company, 2.7% dividend yield. It cost them $1 billion to pay that dividend, and they can cover it 2 times. You can see their free cash flow is about 2 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows, past year 4, that's 44 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 492 million shares. And we get a calculated stock price of $80. They're trading at $76, so they're trading at a 6% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 14 companies in the same industry as Sysco, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, over 800 million. When they open a new manufacturing facility, that's CapEx, and that dollar amount is carried in the balance sheet and appreciated over its useful life. They have the worst debt to equity ratio. For every dollar of equity, they have $6.20 of debt, so they're really leveraged. They pay a nice dividend, 2.7%. Spartan Nash pays 4.5%. I plan to do a video of the top 8 companies in this industry, and they generate almost the same amount of free cash flow as the other 13 companies combined. The sum of these 13 companies is 2.3 billion, so it is a little less. Their market cap is bigger than the other 13 companies combined. That sums to about 28 billion. They're highly leveraged, so they have a really bad price to book, the worst on this list. PE looks good, trading at 18 times earnings, trading at 19 times free cash flow. That's between the median and average. Pretty much all companies in this industry have a really good price-to-sales ratio. They're a little worse than the median average though. They generate a lot of revenue, 78 billion. Look at Performance Food, they're 58 billion. And Sysco's 5-year annual revenue growth rate is only 5%, so they're not growing nearly as much as some of these other companies. HF Foods is number 1 at 32%, Performance is 26%. It looks like they didn't release their second quarter earnings. Their latest 10Q is the first quarter of 2024. Revenue went from 18.9 billion to 19.4 billion. Cost of revenue, 15.8 billion. Revenue minus cost of revenue gives you the gross profit, 3.6 billion, up a little from last year. 2.9 billion of operating expenses. So operating income, 722 million, up from 696 million. They spend 157 million of interest on their debt, 129 million of taxes, so their net earnings is 425 million, really close to last year. Same EPS as last year, 85 cents. Look at that, they're buying back lots of stock. It was 508 million last year, and now it's under 500 million. So to summarize, I have them trading at a 6% discount. My target is 80, they're at 76. I rank them 7 out of 10. Would I buy them 6 out of 10? I don't love this type of industry. It is a pretty stable industry though, but I'd rather invest in Costco. I am invested a lot in Costco actually. I think my $50,000 investment is close to $150,000. I give them 5 out of 10 ratios. They're pretty close to the median in most categories except price to book. That's a bit off. Financial, 7 out of 10. They're growing their revenue nicely. Free cash flow looks good. I'd like to see it grow a little more because their revenue is up 52% since 2021. I'm comparing trailing 12 months to 2021. So that's a growth of 52%. Free cash flow is up 37%. If you like your stable guaranteed dividend, this is the place to go. They pay a nice yield, 2.7%, and I don't see that going away or getting cut. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.